Good morning, everyone. Welcome to ARC WebWindow of Business Cycle Update. Myself, Naresh Senior Analyst, ARC Advisory Group Europe, based out of Dresden in East Germany. And today I'm going to take you through a summary of industry market update report that we have published based on the latest Q3 results for the next 15 to 20 minutes. And I'm going to take you through this report. And this report has been prepared by my colleague Stefan Mesh, who looks after machinery markets very closely, and myself, and which I look after automation markets very closely. And looking at the agenda, I'm going to briefly take you through introduction and methodology, how the charts are created, and how we use the charts and data and so on, and followed by how the automation markets performed, and followed by end user markets, some selected end user markets performances, and an overview of some of the machinery markets and overview picture. And at the end, we'll discuss about sentiment index that we've been doing since late 2020. So we publish a special report providing our clients an industry market update on a quarterly basis. And this report includes indices of revenues from automation companies, machinery companies, and more than revenues from end user industrial markets on a quarterly basis. And this is a special report, and which mainly focuses on quantitative than the qualitative aspects of the markets, for example, automation and machinery, and in industrial end user markets, for example, we also add EPC markets as well as software markets. But in this example, we only cover automation, machinery, and end user markets. Moving on to methodology, and I would like to share with you methodology. And as you can see, the market, we publish indices of these markets, and we segregated in this instance 3 different markets. One is automation index, second one is machinery index, where we collect revenues of about 130 companies from automation companies, and about 400 companies of machine builder companies, and we collect only revenues from these companies, from these 2 different sectors. And when you look at end user industry, we not only collect revenues, we also collect capital expenditures, EBIT, and total assets. And this is the reason, the reason for that is to understand how the industrial companies' capital expenditures have been performing, and how the revenues have been moving, so that we can estimate the growth rates for automation index, for automation markets, based on the capital expenditures performance of the user, as well as revenues of the users. And when you look at, we have cut the industry segments into 13 different industry verticals across hybrid, discrete, and process. And on the other side, when you look at the machinery markets, we have segregated the machinery segment into more than 20 different segments, starting from HVAC equipment and compressors, pumps, fan, and textile, and oil and gas, refining, and so on. On the automation index side, we have segregated market into 3 different regions. One is Americas, second one is Europe, and the third one is Asia. And for example, we are collecting revenues of about 50 companies coming from Asia region on the automation side. And moving on to methodology on the indexing, as we just discussed, we publish the data in indexes, and all the indexes are set to 100 at a given point of time. And in this instance, we have set automation indexes and machinery indexes to 100 back in Q1 2006. But whereas end user index was set to 100 back in Q1 2001. And our indexes are built based on using a Porsche index, and Porsche index gives us flexibility to add new companies, and also to use weighted growth rates to average to calculate the index, and so on. And again, on the methodology, I would like to briefly share with you, we publish charts or data in 2 different variants. One is raw. The raw data is completely taken as it is from the companies as they publish the results. So that's the reason you see raw data, some bumps here and there. But we also publish another line, which is seasonally adjusted. And the seasonally adjusted thing, the line, why we do that is we would like to understand the growth figures and the business cycle, how they're pointing, and so on. And the seasonal adjustment is designed to eliminate fiscal year impacts. For example, Q4 is typically strong for most of the companies, and as well as to eliminate seasonal impact on selected markets. And apart from these fiscal impacts, we also see some extreme values. For example, some companies go through acquisitions and divestitures. When these acquisitions and divestitures happen, the growth rates look like very odd, like extreme values of going down 20% or 30% or without any disruptions in the market. So in this instance, we take 4 to 8 previous quarters and average the market for that particular quarter. And that's on the smoothing side. And moving on to automation markets. And firstly, on the global automation market, a small recap on the global automation markets. If you look at the chart, we have, the global automation market has been encountered, 3 different crises. One is a huge financial crisis in 2008, and the second one was, I think, mixture of oil and gas crisis, a slowdown, and I think overcapacities and some financial crisis, and so on. And the third one is the pandemic. But 2008 crisis was the far worse crisis compared with any other crisis here. And the pandemic was short compared with 2015 crisis, and the recovery was pretty strong. Of course, these high growth are coming from backlogs on prices and volumes. And looking at the current scenario on the Q3, the global automation markets performed with very little growth at low digits, below, I think, looking at here, 4% or 3%. And more importantly, when you see the growth, the year-over-year growth cycle, it has pointed to decline of about 4%. And this is for the first time after recovery started in Q1 2021. So we believe that the market, the global automation market, is going to see a downturn, a downward trend, and the cycle is going downwards. And we expect for the next 2, 3, or maybe 4 quarters, we're going to see a downward trend on the global automation market. And on the positive side, the execution of backlogs and volumes and prices have been supporting the growth in the last couple of years. And if you look at the regional side, Americas was with good growth rates compared with Europe and as well as Asia. Also, the process automation was pretty strong compared with discrete automation. Looking at the automation index in Americas, and automation markets in America continued to grow, but also at the low single digit. But when you look at the year-over-year growth cycle, it is more or less stable, and I think slightly pointing upward trend. And the reason for upward trend in the US market is the large scale projects, and have been announced last year, and most of them are on the electrification, sustainability, and renewables, and energy, power supply, distribution equipment for renewables, and so on, as well as data centers. And we also see a strong demand from process automation, for example, oil and gas, LNG, and as well as chemical industries in the US markets. And that is also supporting the growth and going to support for the next couple of quarters, in our opinion. And apart from the US, Canada, Mexico, and Argentina markets performed pretty well in the last quarter in the Americas market. Looking at the market in Europe, and of course, the market experienced growth rate in Europe as well. It continued to expand, but it has reached a very low growth rate in the last, I think, 10, 12 quarters. And when you look at the growth cycle, as it pointed in Global Automation Index, the growth cycle is pointing downward for the first time after the recovery started in Q1 2021. And we believe that this downward cycle continue in the next at least couple of quarters for the European markets. And the reasons for the downward trend are, for example, the discrete automation segment is pretty weak. For example, missionary segments in the electronics and semiconductor segments were not performing very well. So, and also as well as the backlogs, bottoming up of the backlogs and declining order patterns that we see. So because of that reason, we see the European markets continue to decline for the next couple of quarters at least. Interestingly, Asia has a different story. Of course, the year-over growth cycle points downward trend. I mean, after 4 quarters, but this is with respect to China, slowdown in China. But apart from China, Japan, India markets, and other emerging economies in Asia are performing pretty much good. We expect this is to be like in short term, not long term. Like here, what happened here, and the market, and we expect China is to come back to recovery path almost in Q1 2024, and we are going to see a positive trend in the near short term in the Asia markets. And of course, the market continued to grow above 5% in the Asia region. And end user, let's look at the end user markets. So we have selected 4 end user markets as to showcase here, because each end user industry segment has a different story here, and which stories are very interesting patterns. And let's look at aerospace and defense. The industry has been performing pretty much stable before the pandemic, at least 2014 until 2019, and it has seen good growth in revenues. But the pandemic completely disrupted the industry, and the revenues went up after the pandemic, again went down. But we see the high growth rates in revenues. This was reason because of the expenditures, defense expenditures are continuously happening in the industry. So we see that high growth rates are happening in the revenue side as well as the civil aerospace industry is growing pretty much fast. And when you look at the capital expenditures, we see defense industry segments still need to catch up a lot, and we expect the capital expenditures to continue to grow in the aerospace and defense industry in the next for at least next couple of quarters. And the automotive industry also has a different story, but the story is, of course, the industry has been performing pretty much stable, and this dip, the disruption was not just because of the pandemic, but the industry has already been undergoing structural changes to prepare their productions for manufacturing of electric vehicles. And then pandemic joined the disruption and disrupted completely the industry. But after the 4 quarters, the industry started looking at revenues going up and up. And again, it's pretty much performing pretty well. And when you look at the capital expenditures, yes, of course, the pandemic disrupted here and a little impact here in early 2022, but the capital expenditure started rising again. As you see, revenues are increasing. When the revenues are increasing, there's a trend like capital expenditures will also rise. And apart from that, we see there is a lot of catch-up demand on the electric vehicle side. And also, we see a trend from emerging economies investing heavily on electric vehicles. And we see that this trend, at least the growth path, will continue for the next at least 2 quarters, 3 quarters. The semiconductor industry, unlike aerospace and automotive, semiconductor industry has been performing pretty strong in terms of capital expenditures. If you look at the cycle and the line, the industry has started going up since late 2016, and last 7 years, the expenditures are always up and up. And if you look at I think more than 12 quarters, and the industry was performing about 20%. So the pandemic the industry was not impacted by pandemic at all. And as well as revenues, of course, revenues had a little impact, but that is before pandemic, not the pandemic. And the revenues continue to grow, but when we look at the last 3 quarters, the revenues started coming down, and as well as when you look at the Q3, the capital expenditure started coming down. And we expect that this downturn is going to continue as the cycle is looking downward trend. And this is going to continue at least next 4 quarters, in our opinion, unless the investments in the US and the semiconductors and so on is going to support the market. But we yet to see how much it can compensate the downturn going to happen in the industry. And mining industry. And when you look at the mining industry, this mining industry is, as we all know, interconnected with many other industries, for example, automotive, metals, and for example, battery manufacturing, for example, electronics and semiconductors, all need minerals. And in general, the mining industries have very long investment cycles. And when you look at the capital expenditures here, if I'm not wrong, since 2013, the industry have been going down and down in the capital expenditures, but it has started recovering in early 18, and the last 5 years, the capital expenditures have been growing up and up. But we see for the first time a trend of downward in Q3 2023, and we expect this is to continue. Like in semiconductor industry, we expect mining capex to go down for the next 3-4 quarters. And looking at the revenue side, of course, the high growth rates after the pandemic is with respect to the high metal prices. Of course, that is the reason. And industries, mining companies have seen very high growth in revenues because of the high metal prices. But as we know, the prices have come down and the revenues are going down. And when the revenues are going down, also capital expenditures will go down in the next quarters. So let's look at the machinery markets. I'm going to briefly talk about overview on the machinery segment. And when you look at the fastest growing segments in the machinery, we have mining, machinery equipment, and oil and gas field equipment and HVAC equipment have registered high growth rates, but compared with other machine segments, they have reached a high growth rate. But when you look at Q3, they were very small. They are very small at the growth rates on year-over-year basis. And on the slowest side, which are on the year-over-year basis, have performed declines on the electronics and textile machinery and electronics machinery and glass and ceramic machinery. And the overall picture, like European markets, the industry has started seeing a decline since the recovery started in 2021, late 2021, and we expect that the machinery industry markets, machine building companies, expected to see a downward trend for the next 3 to 4 quarters. So sentiment index, ARC has been tracking the market since 1990s, publishing market studies once in a year. But we moved tracking the market on quarterly basis, publishing reports like I've just presented on quarterly basis to track markets on quarterly basis. But we realized that we need to track markets on monthly basis, not on a quarterly or yearly, during the pandemic time, and that's when we started tracking the market on monthly basis. And this is a simple survey with 3 to 5 questions that we sent to our clients. About 200 respondents on an average take the survey, and asking the simple questions: how was the last month, and how is the current month compared to last month, and how would the next month look like compared to this month. And when you look at the results, when you look at the chart, yes, the respondents said they are seeing low revenues or maybe low negative scenarios starting from March, and in May it went down, and of course it's stable, and in August it went down, and September again down, in October a little bit up, but in November again it back to down. And when you look at the current month, overall observations say that the overall economy activity is going down. Of course, there are positive trends that are happening from the US and the investments in the semiconductors, renewables, electrification, and hydrogen. And but we had to see how much the positivity and the growth US could compensate the downturn going to happen in the European markets and on the global scale. And when you look at the next month compared to this month, many of the respondents said that they have reached the end of their order backlogs, and some of them said destocking and receiving negative orders, and I mean there are declines in orders, so which are all pointing to negative growth rates going forward for the 2024. So as a summary, we would like to give an outlook. In our opinion, 2023 is expected to see growth rates between mid to high single digits. And the reason for the growth, as we discussed before, of course, huge execution of backlogs and high price and high volumes. Of course, the process and hybrid were performing well compared to discrete automation, and America's market were performing pretty much good compared to Europe markets. And but when we look at 2024, on an optimistic note, we say no growth or moderate, but on a realistic note, we see a downturn. And of course, there are positive things to support, for example, process and hybrid segments and energy segments are there to support the growth, and also discrete automation is expected to come back in the later half of the year, as well as large scale projects are there, but we had to see how much these positive things to compensate the downturn going forward. And that's all from my side. And thank you very much for joining us. I wish you a good day.